Investing is a way to put money aside while you're busy with life and have that money work for you to reap the full benefits of your labor in the future. The goal of investing is to put your money to work in one or more types of investment vehicles in the hope that it will grow over time. For example, assume you have $1,000 saved up and are ready to dive into investing. Or perhaps you only have $10 extra per week and want to start investing. So in today's video, we show you the guide to investing in stocks and everything you need to know if you are a beginner in this field. And if you enjoy such content, make sure to like this video, subscribe to our channel, and turn on the notification bell icon to never miss another upload of ours. Here we begin! What are stocks? A stock, also known as equity, is a financial instrument representing ownership of a portion of the issuing corporation. Shares are units of stock that entitle the owner to a proportion of the corporation's assets and profits equal to the amount of stock they own. Stocks are primarily bought and sold on stock exchanges and serve as the foundation of many individual investors' portfolios. Therefore, stock trades must adhere to government regulations to protect investors from deceptive practices. How do you buy stock? Stock exchanges, such as the NASDAQ or the New York Stock Exchange, are where most stocks are bought and sold. Following a company's initial public offering or IPO, its stock becomes available for investors to buy and sell on an exchange. Typically, investors will use a brokerage account to purchase stock on the exchange, which will display the purchasing price, which is the bid, or the selling price, which is the ask or the offer. The stock price is influenced by market supply and demand factors, among other things. Benefits of investing in stocks. Investing in stocks has numerous advantages. It has the possibility of earning higher returns. Most people invest in stocks because of the potential return when compared to alternatives such as bank certificates of deposit, gold, and treasury bonds. For example, since 1926, the average stock market return has been around 10% per year, while long-term government bonds have returned 5% to 6% per year. It provides the ability to safeguard your wealth against inflation. The stock market's returns frequently outpace the rate of inflation. For example, since 1913, the long-term inflation rate has averaged around 3.1% per year. This is in comparison to a double-digit annual return on stocks. As a result, stocks have historically been a good way to protect against inflation. The ability to generate consistent passive income. Many businesses pay dividends or a portion of their profits to shareholders. Although some companies pay monthly dividends, the majority pay quarterly dividends. As a result, dividend income can supplement an investor's salary or retirement funds. Ownership satisfaction. A share of stock represents a company's fractional ownership. You can own a small portion of a company whose products or services you enjoy. Availability of liquidity. Most stocks are traded publicly on a major stock exchange, making them simple to buy and sell. It also makes stocks a more liquid investment than other options, such as real estate investments, which are difficult to sell. Diversification. Stocks allow you to easily build a diverse portfolio across many industries. This can assist you in diversifying your overall investment portfolio, which may also include real estate, bonds, and cryptocurrency, lowering your overall risk profile while improving returns. What are the risks of investing? Investing is a current financial commitment to a future financial goal. Of course, there are various levels of risk, with some asset classes and investment products being inherently riskier than others. However, virtually all investing involves some level of risk. It is always possible that the value of your investment will decline over time. As a result, one of the most significant considerations for investors is how to manage risk to achieve their financial goals, whether short-term or long-term. What are the different types of investing? First is dividend investing. Dividend investing can be a very profitable investment strategy. Dividend stocks have historically outperformed the S&P 500 while experiencing less volatility. This is because dividend stocks offer two types of returns: regular income from dividend payments and capital appreciation from stock price appreciation. Over time, this total return can add up. Due to their lower volatility, dividend stocks often appeal to investors looking for lower-risk investments, particularly those in or nearing retirement. However, if you don't know what to avoid, dividend stocks can still be risky. How to choose dividend stocks? Before you buy any dividend stocks, you should understand how to evaluate them. Understand its yield on dividends. This represents the annualized dividend as a stock price percentage. So for example, if a company pays $1 in annualized dividends and its stock is worth $20 per share, the dividend yield is 5%. When comparing a stock's current yield to its historical levels, yield can be used as a valuation metric. Of course, all else being equal, a higher dividend yield is preferable, but a company's ability to maintain and ideally increase its dividend payout is even more important. On the other hand, an unusually high dividend yield could be a red flag. Dividend payout ratio. The dividend is a percentage of a company's earnings. If a company earns $1 in net income per share and pays a 50-cent dividend per share, the payout ratio is 50%. In general, the lower the payout ratio, the more sustainable the dividend. The dividend is calculated as a percentage of a company's operating cash flows minus capital expenditures or free cash flow. Because GAAP net income is not a cash measure, and various non-cash expenses can cause a company's earnings and free cash flow to vary significantly from one period to the next, this metric is important. The total return is the sum of the increase in stock price or capital gains and dividends paid. For example, if you pay $10 for a stock that gains $1 and pays a 50-cent dividend, the $1.50 gain is equivalent to a 15% total return. The second is value investing. Value investing seeks stocks that are trading at a discount to their intrinsic or book value. As a result, value investors tend to add stocks that are undervalued by the markets. The entire premise or idea here is that value investors believe that the current stock price is out of sync with the company's long-term fundamentals. As a result, value investors view any bad news that lowers the price of a fundamentally sound stock as an opportunity. Parameters considered when selecting value investing stocks in general, value investors seek stocks with high dividend yields, low price-to-earnings, or price-to-book ratios. This is because history shows that low price-to-earnings ratios typically outperform. As a result, the downside risk in these stocks is also mitigated. Another criterion considered is low price-to-book value. A lower price relative to the script's net assets protects the downside risk and thus appeals to value investors. Other criteria used in the value investing strategy include stocks with a low price-to-cash flow ratio and those with a positive earnings outlook. Furthermore, after observing a decline, value investors can pursue stocks that have been trading in range. Third is growth investing. It is an investment strategy that seeks to increase invested capital by selecting growth stocks, which can be small or young companies with the potential to outperform the industry or market as a whole. This investment strategy can be focused on equities or on thriving private companies. Though some risk is involved, growth investing can help with diversification and be part of an investor's overall investment strategy. Finally, the last one is passive investing. Passive investing is a method of maximizing returns by minimizing buying and selling. For example, index investing is a common passive investing strategy in which investors purchase a representative benchmark, such as the S&P 500 index, and hold it for an extended period of time. There are some of the key advantages of passive investing. Fees are extremely low because no one picks stocks, so oversight is much less expensive. Passive funds track the index that serves as their benchmark. It has transparency, which means the assets in an index fund are always visible. Provides tax efficiencies, where their buy and hold strategy typically does not result in a significant capital gains tax for the year. Simplicity is there in that owning an index or group of indices is far easier to implement, and understand that a dynamic strategy that necessitates ongoing research and adjustment. It has some drawbacks too, like minimal options, as they are restricted to a specific index or predetermined set of investments with little to no variation. As a result, investors are locked into those holdings regardless of market conditions. Potential returns are lower here. Passive funds, by definition, will almost never beat the market, even during times of turmoil, because their core holdings are locked in to track the market. As a result, a passive fund may occasionally outperform the market, but it will never achieve the large returns that active managers seek unless the market itself booms. So, finally understanding when to sell or hold an investment. Choosing whether to hold or sell a stock can be a difficult decision. There is no one-size-fits-all approach to selling a stock. Instead, it is up to the individual investor's investment strategy, which is based on a variety of factors such as risk tolerance, time horizon, and financial goals. Suppose an investor is unsure how to develop that strategy. In that case, they should educate themselves or contact a financial professional to assist them in developing an investment plan that meets their financial objectives. Are you a beginner in investing too? If so, then follow this guide and start investing in getting great benefits, keeping in mind it can be risky too. Let us know your views in the comments below, and make sure to subscribe for more.